All right. Well, hello, everyone. Bear with me one second. All right, here we go. Thanks for joining our first official COVID-19 weekly market impact webinar with David Arbit. We're really excited that you're taking an hour out of your day to be with us virtually. I'm Rosie Hatfield, the Client Relationship Manager at MAR. And before we get started, just a few bits of housekeeping. For the sake of being able to hear David's presentation, please leave yourself muted. If you have questions that pop up throughout the presentation, you can utilize the chat feature in Zoom to send them to us, and we will address those throughout. If you have your video turned on, please remember that we can see you. So if you don't have pants on, might not want to stand up. Don't take us to the bathroom with you. We are recording this session and we'll be posting it on our website shortly. That's all I have for you right now. So with that, hand it over to our Director of Research and Economics, David Arbit.
All right, thank you, Rosie. Rosie and her team do a great job of making sure you guys have the information you need. And so we're really grateful to her and Lacey and the team. So thank you guys. Let me make sure everything is good to go here. I'm gonna try a little timer thing this time. Keep me on track here. Okay. So thank you so much for joining us today for an update on the residential Twin Cities housing market and some of the changes we've been seeing lately regarding the impact of the coronavirus. The only thing that really matters here, folks, we hope you and all your loved ones are safe and healthy and well and not getting too stir crazy. I also want to mention we have a resource page from our homepage. You guys will see the link right at the top. It's mplsrealtor.com/coronavirus-resources. Our team has really invested time in making sure you guys have the info you need. What are the 3 Ps again? To be profitable, productive, and protected. I like those 3 Ps. That's what we say. So with that, want to also ask for your patience and understanding. We are learning to navigate this new normal just as you are. If it sounds like we can't perfectly predict the impact of pandemics on the housing market and on home prices, well, it's because we can't, and almost nobody can. And anyone who says they can, you should question their truthfulness. As Rosie mentioned, please do keep your mics muted. As much as we enjoy barking dogs, your wind chimes outside, and your coffee slurps, we're going to try to keep that to a minimum. Okay. Everything here, you guys, really depends on 3 things: the length of the pandemic, the impact of unprecedented levels of stimulus and relief and new policy tools and monetary tools, and then third and lastly, the consumer response and reaction and how that's going to drive consumer behavior and ultimately consumer spending and home buying purchases and other major purchases. So we're going to kind of be returning to these 3 a few times, so just keep these in mind. Okay, so just a quick note on showings. Some of you have seen there is now a virtual showing option. I don't know if you guys are all aware of that, but there is now a virtual showing option in the Showing Time app right in the North Star Matrix system. So just a quick word here, showings are one of the better leading indicators of demand that we have. I also want to say we're only capturing virtual showings if they go through the system, but then again, that's the case for all showings. And there is now a virtual showing option, just like we mentioned. And this is the shortened version. This is the too long didn't read version here. Okay, daily showing activity. This is something that we've been utilizing with the media, a few different places whenever we get asked questions about what's happening and what could be driving it. So daily showings using a rolling weekly average, otherwise the daily numbers are just too volatile. They're kind of all over the place. So you guys can see, going back to the, more or less to the first of this year, it's actually January 7th because we needed that first 7 days to create a weekly average. You guys can see how showings activity have been on the rise until March 6th hit, and that's when we had that first positive confirmed case here. Looks like you can see the impact of that. The second green dot, this is when Governor Walz declared the peacetime state of emergency. You can kind of see a little bit of an effect there. And then 2 days later, we had the closure of the schools. And that seems to be really what kind of kicked off this, this fairly notable decline. It looked like things could be sort of stabilizing a little bit around the end of March. But then when we had that shelter in place order, it seemed like things kind of deteriorated just a little bit further. But the good news is we seem to have stabilized for now. By the way, folks, this decrease here, excuse me, this is a result of the Easter and Passover weekend. So no surprise that we've kind of come back from that. All right, so let's think through a few things here, and I want you guys to kind of help me think through this. So we're hearing anecdotally and we're seeing in the data that the slowdown is most noticeable in the luxury segments, right? There seems to be a wealth effect there where luxury buyers are much more affected by the stock market. So this perceived wealth effect can obviously affect confidence, spending, major purchases, other behavior. You don't have to think too hard, folks. Someone who might have had a $3 million net worth at the beginning of February could very well be worth $2 million today because of some of the changes in stocks. So just be aware of that. So luxury markets seem to be hit pretty hard. But what about younger first-time buyers? Maybe millennials, maybe folks who are working hospitality, leisure, restaurant, bar, retail. A lot of those folks lost their jobs and they may not be as likely to buy. So maybe we'll see this decrease in million plus, but we may also see this slowdown in maybe $250,000 and under. So let's see. By the way, look at the non-farm payroll report. Where were most of the job losses? The vast majority were in leisure and hospitality. So that's kind of affecting the millennials, first-time buyers, folks who need to be in the affordable segment. I'd also point out, look at the change of employment by educational attainment. A lot of the decline seems to be for workers with a high school diploma and less. So we can definitely see some interesting trends there as well. So we still do have strong demand, as I think you all know, and weak supply in that 200 to 300 market. Some have called it the 2 to 350, 150 to 3, however you guys think about that sort of entry-level first-time buyer market. And those dynamics should, maybe I should say could, keep prices propped up depending on that number one issue that we started with, the length of the outbreak. So this kind of gives us a theory. If we may see weakness at the bottom end, some weakness at the top end, and maybe the middle market is where we see things doing pretty well. Let's see if we're right. All right, so we're kind of right. As of the end of March versus that, so it's basically the 4th week of March versus the 3rd week, we did see that pattern where you saw the largest declines in showings were sort of, we saw notable declines in these affordable segments, a little bit less of a decline in these middle market segments, and then the most precipitous declines, of course, as you get into the luxury bracket. So 800K plus, especially $1 million plus, we saw nearly 45% decline in showings activity just from 1 week to the next. So our theory is sort of right. How about most recently, 412 versus 45? This is a little bit interesting. We don't see as clear of a pattern, and maybe that's to be expected. Saw a little bit of recovery here and here. Definitely saw some of those gains given back here. This part of the mid-market was down a little bit, even though there was some strength in that 450 to 600 market. Be careful with this one, you guys. This plus 16% change, let's see if I get my math right. I think it was from 13 showings versus 15. So that's 2 more showings driving a 16% increase. That's what we call a thin market or small sample size. So just be careful there, just be cautious. Well, so we're talking about affordability in middle market versus luxury. So let's look at the share of first-time home buyers and how much they have been in the market lately. Of all home sales, and by the way, guys, this is national, so just so you guys know, 33% of all sales were first-time buyers. Now, maybe our longer-term average is maybe like 38 or 40. We even had some 42 and 44 years some time ago. Notice when home prices went on sale after the Great Recession and the mortgage crisis in 08-09, actually 50% of buyers were able to be first-time buyers. No surprise there. When home prices went on sale, more folks could come into the market. As we've seen prices rise, we have seen this fall just a little bit, but it has been fairly stable. Similarly, as we're talking about some of the folks at that entry-level market, let's look at the median age of home buyers. This is kind of a similar story here. So we've got first-time buyers in purple here, or maybe magenta. I'm not excellent with my colors. So it used to be the age was 32. Well, it was 29, and then 30, and then 31, 32. And then when home prices went on sale in 08-09, actually 30-year-olds could be first-time buyers versus 32-year-olds. Again, as we've seen prices rising, now first-time buyers are having to wait until they're 33 years old, which is kind of interesting because 33% and 33 years old, some kind of rule of thirds there. So the first-time buyers, the millennials, are they not really feeling it this time? I just can't figure out why. Millennials living through their second once-in-a-generation economic collapse, giving a little elbow bump there. And then Jennifer Wright, who I think is with Harper's, she's saying millennials finally stopped going out for avocado toast. So can everyone now afford a house? I don't know if it's that simple. So let's think about how this slowdown, let's think about this slowdown in showings and just dig in a little bit. So some people have said, especially some of the builders I talk with, how much of this is a real slowdown versus how much is those who are just looking for fun or snooping, as some of you have called it. So showing traffic is down, but it seems to be a higher quality and more motivated buyer. That's what we're hearing. I don't have data on that, so I can't say that with certainty, but I know we've heard that from you guys out there, as well as from other folks in the industry. So maybe that's the more true qualified buyers are kind of still out there, but some of the fringe buyers have sort of dropped out and moved on. Maybe it's not worth the risk if I'm not serious and committed. Okay, so let's keep digging in a little bit and peel back the layers of the onion here. This one shows overall showing activity by price point, right? So we can see our under 200, our 350 to 450, 6 to 8, 8 to a million, and million plus. And again, this is for the prior week, and this is sort of for the most recent week that we have data for. So you can see an increase in under 200. You see that decrease in 2 to 250, a little bit of a gain in million plus, although it's hard to see. And because it's hard to see, I'll tell you what, I'll make it easy for you guys. Let's look at the share of overall showing activity instead of just the number. Let's look at the share. So what this is telling us is most recently, 16.2% of all showings in our market were in that 350 to 450 range. About 1 in 4, right, 25% of all showings were actually at or below that 200,000 mark. Over here, I actually had to add not a 10th place, but a 100th place, just to show, just to kind of tease out some of the details of what's happening in these segments. So guess what? You know, it was looking like 0.6. This changed a little bit, but it was 0.64 and 0.56. Well, those both round to 0.6, and that's not good enough for you guys. So we wanted to kind of expand that a little bit. So we do see some growth here in million plus, but it's still only commanded 0.2% of all the showings across the region. All right, let's pivot into new listings here. So this is last 3 months going back to roughly the beginning of the year. We've got current activity here in blue, and then we've got year ago activity for 2019 in this gray dashed line. So it appears that seller activity sort of hit its peak for at least so far this year, sort of beginning of March. We can see how that's come down a little bit. Again, some evidence these declines are slowing, but I think it's still too early to say. And remember, if you look at 2019, this is at a time when we would expect gains in new listing activity, gains in seller activity. But let me also say, 2019 was sort of a weird year where you have suppressed activity here because of weather. So maybe this was sort of a relief rally, if you will. Not to read too much into the tea leaves, but hey, that's what I do. Okay, how about pending sales? Again, this year in blue, 2019 in gray. Pending sales sort of stood their ground for a little bit longer. We see that decline happening just about the mid-month mark. I think it was, what was that? Was it March 15th when the schools closed? So this aligns really closely with that, no surprise. We have seen these declines most recently over the last couple weeks here. We have sort of gone below those year-ago levels. Inventory. Again, the number of active listings. This has been a pain point for a lot of folks in the market who are trying to get deals done, especially under 250, under 300. We're all well aware of that. So again, at a time when we would expect active listings or inventory to rise, we've actually seen just the opposite. So those who are expecting more choices for buyers, I would say that probably won't be the case now or probably for the near future. Okay, change in pending sales. You know what? This is a little old. Let's skip that one, and I think I got a newer one. So this is daily new listing count, again using our rolling average. So this one I actually like a little better. Actually, I like it much more because this will have the last 3 years. So 2017, 18, 19, and then current year 2020 here in black. So as we can see, new listings were actually looking pretty strong. They were sort of leapfrogging a little bit with 2017, which was a strong year for sellers as well. You guys can see how new listings continued on their ascent in 2017, but clearly something happened here, and it was kind of that end of March where we saw this decline begin. The declines have continued, but again, there's some evidence there that we see some stabilization, and we'll get into that. All right, so similarly, we're going to do that same trick with pending sales. Again, you guys, I really want to point out, look at this black 2020 trend line. For a lot of this year, it's actually been ahead of, it's actually been the strongest it's been in 4 years for pendings, until all of a sudden it wasn't. And then we see the declines kind of begin again, right around that mid-March mark. Let's point out one more thing here that I think is noteworthy. So here we are, okay, about 140 a day on the rolling average. What does that get us back to? About mid-Feb, maybe a little bit earlier. Well, what about new listings? So new listings down here, this is actually back to what, maybe late Jan levels. It's not actually that much above where we started the year. So I guess that's an interesting insight there. Okay, let's do a sneak peek. And I'm talking a sneak peek with an E and not a sneak peek with an A, which would be a sly, crafty mountain. And that's not what we're talking about. So just remember, you guys, this is March, not April. And we know that the first half of March looked almost nothing like the second half of March, as we just saw. And let's also keep in mind that this is still compared to a snowy and then a very wet March 2019, where a lot of sellers had wet basements or for other reasons, they were sort of keeping product off the market. Okay, sneak peek. I will ask that nobody leaks this to the press prematurely. This goes out tomorrow at our press release. So you guys, because we love you guys, you're getting kind of a sneak peek there. So change in new listings. So this is seller activity by price point. So this is the metro. This is March of this year compared to March of last year. So again, we kind of have this, I don't know if it's a hollowing out effect, but we have these middle market price ranges seem to be performing the best. We saw at the extreme affordable end of the market, saw a 22% decline in seller activity. And we actually saw nearly a 32% increase in listings between 250 and 350. Again, million plus actually up 6%. $750,000 up to $1 million, down about 10%. And so that totaled overall about a 17% increase. So again, we see these declines at the far high end, the far low end, and we still see these middle market price tiers seemingly performing the best. Okay, so that was new listings. Let's pivot over to pending sales. So this is sort of, again, buyer activity. I want us to be thinking, you guys, I want us to be thinking about the life cycle of a listing. So it's first listed, then it's shown, then it goes pending under contract, and then it closes. So we're kind of playing this game of trying to get an earlier and earlier read on what's happening, especially nowadays with a rapidly changing environment with everything going on. So again, here we see the similar pattern where we saw pending sales down 44% for under 120K. Well, think about the buyers in that price range, and well, really in these three price ranges. A lot of those would-be buyers have been really hard hit by the losses, the job losses that we've seen. Again, our middle market ranges seem to be performing relatively well, even getting up into, you know, this maybe the first rung of the luxury segment for those of you who think it's 750 and not $1 million. Again, we see this $1 million plus segment down 36%. So pretty dramatic declines there as well. And I think I've got some arrows just to illustrate that point. And there we have it. Kind of looks like a normal distribution, but be careful, it's not a paranormal distribution. All right, few jokes. Maybe they're more for me than for you guys, so thanks for bearing with me. Okay, you know, let's look at March versus March of this year. Again, we see some pretty strong gains here, but I would really encourage us again to think about the fact that the first half of March was quite different than the second half of March. And remember, I want you guys to remember this gain in closed sales. Well, a closed sale in March was what? Probably a contract entered into in maybe December, probably January, maybe even February, before the whole world changed. So again, first half really different than the second half. We saw an increase in prices for March. Again, the first half kind of dragged the second half up with it. And we still see a really tight market with 1.7 months of supply. Sellers were getting 99.25% of their list price, which is over a 0.5% increase compared to last March. All right, I know some of you have seen these. These are, as soon as you guys log on to North Star, you guys will see some links in some of the notifications there at their splash page. I wanted to point out just a few of these and kind of compare us to other states. So here we are, Minnesota. Here's our 2020 average showing activity versus 2019. You guys can see these both start at 0. And then, you know, when this is plus 60%, it's 60% above where it started the year. So 2020 at one point was actually what, about 10% below where we started the year. But look at what's happened in the last week or so. We're actually back to about break even, which may not be the greatest news we want to hear, but at least it's better than where we were. So we do see a little bit of an uptrend on the showing side as of late. Again, last week or two, 2.5 maybe. Okay, so that's Minnesota. I want you guys to remember, we are just getting to above that 0 line. So keep that in mind. How about our friends to the east, Wisconsin? Still not above that 0 line, but they have stabilized a little bit, but they're still not above 0. How about our friends in Iowa? They are above 0. Actually, they're probably more above 0 than we are. So Iowa, interesting case study there. How about Ohio? Still well below 0, maybe down 15 or 10% or so. So faring a little bit worse than we are. How about our friend on the West Coast, California? Showing activity still down 55% compared to the beginning of the year. So a long ways to go until they get to kind of back to break even with the beginning of the year. A little bit of stabilization, little wave up, maybe a second wave up. We'll have to watch that. Massachusetts, similar story, still down 20%. I think I only have a couple more. North Carolina, still down 40%. Ontario, how the heck did that get in there? Anyway, Ontario still down as well, about 60% or so. Our Canadian friends to the north. So, you know, maybe we're not doing so bad in the scheme of things and compared to other states. And actually, a lot of those states, maybe California and a few others notwithstanding. Some of those states do share a lot in common with us in terms of economy, demographics, home prices, and so on. Again, California, the outlier. Okay, so let's take a look at the 30-year fixed rate mortgage. Some would say this has been a silver lining in a situation where there aren't that many silver linings. So let's take a look at what's happened here. So this goes back to 2012, but I want to show you guys most recently, look at where we are, or at least where we were a day or two ago. I've been seeing and hearing 3.3, 3.4%, depending FHA, conventional, and depending 5, 10, 20 down, and all these variables that always make an impact. But I mean, this is about as low as the 30-year fixed mortgage rate has ever been. So again, a little bit of a silver lining for buyers. And remember when rates almost touched 5%, and that was at the end of 18 and sort of beginning of 2019 when they came down. So this is a result of the Fed, the Federal Reserve, I suppose, as well as the federal government, throwing a lot of stimulus and a lot of monetary policy at the economy to try to minimize and control the fallout. Of course, that has kicked off a major wave of refinance activity. So look at the refinance activity for this year. It is almost at levels we haven't seen since 08 and 09. When rates went down here in 13, we saw another wave of refinancing. And then after the dot-com bubble burst in 01, we also saw a huge wave in refinance activity. I don't know if you guys talk to your lender friends. I have a couple friends in the mortgage side of the space here, and they have said they are just so swamped. And this is after they've actually laid off some people, because remember, when rates went here, it kind of felt like they'd keep going and they'd keep normalizing. So, I don't think anyone expected us to retest these lows. But here we are. Life is filled with surprises. We've actually even heard that some of the originators and underwriters are having to jack these rates up just a little bit on their end, just to throttle the demand, just to kind of throttle the activity. And that actually brings up another good point that I heard just the other day. A lot of the closings that may be canceled or pendings that don't close, and I'm not saying that's a majority of activity. It's surely a chunk, probably more than it has been. But just remember, some of those are finance related and not necessarily supply demand or market related or consumer confidence related. So just keep that in mind. Maybe another grayish or silverish lining, gas prices. They're really low, but where are you going to go? We're all kind of stuck where we are. So gas prices under $2 a gallon. It's not that long ago we remember $4 a gallon. I actually heard someone, and I can't remember if it was Andover or Coon Rapids, someone said they saw less than $1 a gallon. I never thought I'd see that in my lifetime again. Well, but look at the miles driven, right? We're driving 41% fewer miles since February 2nd. So we're kind of all dressed up with nice gas prices, but we've got nowhere to go. By the way, anyone who appreciates clean air, may I recommend taking a walk? This might be some of the cleanest air we'll see in years. Okay, so shifting gears a little bit, let's think about the dot-com crash and the post 9/11 crash. So here, the S&P 500 had a 45% correction over, over this 2-year period. How did home prices fare during that period? 2000, they were up 8.5%. 01 up 6.5%. 02 up 8.5%. Again, this is a really, really important theme, and I want everyone to really note this. First of all, the stock market is not the economy. I'll say that again. The stock market is not the economy. I will also say a recession does not always mean that home prices must fall. I'll repeat that. Home prices do not always fall during recessions. This is important. So let's take a look at the last 5 recessions, and this is new homes only. So this is new construction. Here's the 80-81 recession. New home prices rose. 91, they fell. 01, they were up 6.5%. And then, of course, 08, they were down. But remember, this was a housing-caused recession. So actually, 3 out of the last 5 recessions saw gains in home prices. So 60% of the recessions also saw gains in home prices. That was new. How about all sales? So this is the last 6 recessions, and we're looking at the start of the recession in gray. So this was the national home price at the beginning of the recession versus the home price at the end. What I see, hopefully it's what you guys see, this recession, prices rose. This one, prices rose. This one, they rose. This one, they rose. This one, they rose. The only time that overall home prices nationally, not in Minnesota, not in California, not in Chicago or Seattle, but nationally, the only time they fell during the last 6 recessions, was that most recent recession, which was a housing caused recession. And I should say mortgage finance caused recession as well. And also maybe a Wall Street gambling caused recession, just to make sure we spread the blame around a little bit. So I think there's some recency bias going on, right? Buyers who are out shopping are biased by the 2008 recession, right? They expect lower prices, even though we don't always see lower prices during recessions. In fact, most of the time we don't. That's not to say we won't this time, right? No one can predict that. But because we're so undersupplied now versus being oversupplied back in 2008, I see it as less likely. Again, not a guarantee, but less likely. So buyers who are out there are expecting some price cuts and some favorable pricing. Buyers are expecting lower prices, but sellers aren't. So this expectation could be holding sellers back from listing, in addition to some of the health concerns. Let's remember, though, most sellers are also buyers, minus those who are maybe moving out of state or going into senior care or something like that, or going to double up with a family member for a multi-generational type living arrangement. So if those sellers aren't listing, they're probably also not buying. And so we have a little bit of a cyclicality, a cyclical feedback loop there. Per NAR, in general, are home buyers expecting lower prices? 37% no. And forgive the quality on this, you guys. I wish it were a little sharper. 16% said yes, but by less than 5%. About 25% said yes, maybe by 5 to 10%. And then you can kind of see how that looks from there. Speaking of Wall Street, just a minute ago, let's look at what they're forecasting. All the big dogs on Wall Street, Goldman, JP Morgan, and Morgan Stanley, they're all forecasting sort of various types of a V-typed recovery, not a U-shaped recovery. I've heard of a W-shaped recovery. Someone actually even talked about an L-shaped recovery where we kind of go down and stay down. And I just don't see that happening, especially because the economy was still fairly strong before we got into this. So this one I actually believe is more telling. This happens to be from the Oregon Office of Economic Analysis. So here's what we've seen, you guys. We've seen this sharp decline. Again, stocks aren't the economy, but this decline in stocks, a decline in jobs, an increase in the unemployment rate, and everything that goes with it. We have this initial bounce back. Some argue we're already kind of there. Some argue maybe not yet. And then we can expect slower growth until the health issue gets under control. And then after that gets under control, we will either take something like that kind of trajectory or that trajectory, depending on really the 3 issues that we talked about at the beginning. How long this thing lasts, I guess that's kind of here. What is the impact of some of the policy, fiscal, and otherwise that we've seen, and how will consumers respond and react? Shallow or deep recessions, quarterly change in GDP following recessions. I think the big thing to note here is that that 07-08 recession, right? It took 14 quarters to get back to 100% of GDP. After we lost 4% versus coming back to 100. You guys can see this was a fairly wide trough. That is an exception to the norm. You can see also most of these other recessions, some of them are 2 quarters, some 4, some 5 or 6. I would think it's unlikely that it lasts that long. How many of us woke up today thinking we'd see a chart for Hong Kong GDP? I would argue probably not most of us, but it actually tells a really compelling story. So look at the SARS outbreak. It began in February of 2003. This is the dashed line is the GDP trend. The blue line is the actual GDP. So the SARS outbreak kind of takes hold, GDP declines. Into June of '03, looks like it bottomed, and it was kind of back on track with this trend by October of '03. So what is that, 6, 7, 6, 7, 8 months later? Again, not a guarantee that will look like this, but it's just interesting to know how other regions fared when they had similar pandemics and viral outbreaks. All right, just a very quick moment on this. Let's do a quick time check. I think we're doing okay. Government issued versus subprime. You guys see subprime really kind of went away after 06, 07 for fairly obvious reasons. And it really hasn't come back, even though this chart is a little old. So I think another thing to note is in '06, look at how we treated our ATMs, sorry, our houses. I didn't mean to call them ATMs. Well, we treated them like ATMs. That's why it was kind of a joke, but kind of serious. We extracted $85 billion in equity, $85 billion out of our homes in '06. How are we doing now? We've taken about 20 billion out. Remember, home prices are above where they were here. What does that mean? Even if home prices were to soften a little bit, and again, we're not forecasting that's necessarily going to happen, look at the extra cushion that homeowners have before they go underwater. They have a huge cushion compared to last time. I think that's a really important point. Okay, shoppers using technology. 3D home tours soared as these stay-at-home orders expanded. So we really see this 600% surge in these kind of virtual tours and 3D tours, and there's a lot of different companies that operate in that space. Okay, this is from Apartment List, and they survey some renters. In April, did you make your rent or mortgage payment? I should say they survey homeowners as well. All right, 3 out of 4 people, or 75 out of 100 people made a full payment. 13% partial, and a little over 1 in 10 made no payment. So, I'm a glass half full guy, at least I try to be. I'm also a realist. So, 12% may not seem like a ton, but I think we should combine these and then, or basically what's not here. So 25% did not make a full payment. Some made partial, some made no payment. We can kind of see how this breaks down, renters versus homeowners. So this is partial versus none, partial versus none. Obviously, you see that is more prevalent in these, in the lower income quartiles or quintiles, if you will. As we climb the income ladder, obviously more financial wherewithal to sort of shoulder this kind of shock, or to withstand this kind of shock. Turns out, maybe not in Silicon Valley, but income tends to rise as age rises. So again, we see a little bit of overlap there. Let's skip this one. I think there's a few others that I want to cover. If you were to lose your income indefinitely, for how many months could you afford your current housing costs? 80% of renters said 1 month, right? 89% of mortgagees, or homeowners, I should say, 90% said at least a month. 75% said 2, 46% 3 to 5, and almost 1 in 4 said they could keep paying for 6+ months, versus only 1 in 10 on the renter side. So as long as we're talking rents, and we won't spend a ton more time talking about that, there's pretty good evidence, and I think this is from Harvard. Yeah, this is from the Joint Center for Housing Research out of Harvard. So folks way smarter than I am. The pandemic will likely cool what is an already slowing rental market or rental demand. So here's the change in renter households. We actually saw a decrease nationwide. That doesn't necessarily apply to us, but it's tough to get data like this locally because we're not members of CoStar. I know CoStar has that data. 2019 did see a little bit of a gain, but obviously nothing like we've seen since the Great Recession. And it's no wonder we saw that gain. People were burnt fairly hard back here, especially luxury rentals. We're hearing Maybe if the asking price on a luxury rental is, I don't know, 21 or 2200, we're hearing that property managers are letting some of those go at maybe 18 or 1850. So I think there are some deals to be had, especially in the luxury segment, which, by the way, there's pretty good evidence that luxury rentals are overbuilt. So perhaps a little bit of a saturated market there. So another interesting thought, right? Remodeling activity was already up from the inventory shortage and from our affordability challenges. Let's just look at Home Depot's stock, right? It's been fairly relentless since '08. As we're staying in our homes a little bit longer, and as we have an aging population, we're staying in place, again, a little bit longer, and we're remodeling. So you can really see the impact of that. By the way, none of this here today constitutes any sort of stock or equity or bond market advice or any sort of financial advice of any kind. Thank you. All right, let's try to read minds a little bit, shall we? It's not usually something I do, but why not? Everybody's going out of their comfort zone nowadays. The one big question on your mind, how will this impact home prices, if at all? The short answer, I don't know, and nobody does, right? The long answer is, well, it depends on what, again, are three things: length of the outbreak, the efficacy of our policy and monetary tools, and the consumer reaction and response, and how that drives consumer behavior moving forward. I will ramble for just a moment here. So we are still so undersupplied that we could even double or actually even triple inventory, and we still wouldn't be in a buyer's market. So we now have about 8,000 active listings on the market. Let's say that tripled, let's even call it 25,000. Well, we're selling about 5,000 homes a month. Some of the winter months could be 2,000 or 3,000. Some of the spring and summer months could actually be 6,000, 7,000, or 8,000. So it averages out to about 5,000 a month. Well, guess what? 25,000 active listings divided by 5,000 sales equals 5 months of supply. Still, I guess technically it's a balanced market because most say 5 to 6 months is balanced. Some say 4 to 6 or 4 to 7. So again, we could triple our inventory and still be in a seller's market, or at least a balanced market. So again, even a tripling in inventory won't put us into a 8-10 month supply sort of environment where it's a buyer's market. So again, that also assumes that demand holds steady. If the outbreak doesn't get under control for some time and enough buyers pull back, so let me also say, if enough buyers kind of outright cancel their plans versus delaying them, there's a chance that could force sellers who have to sell, not those who want to sell, but those who have to sell, could chase buyers lower with price reductions to try to lure them in, which could, of course, then become comps for neighboring properties. Not that unlike what we saw in '08, although if it happens at all, it will be nothing like the kind of declines that we saw. That I'm fairly confident in. But again, there's just so much variability and so many dependencies that, it's really hard to say. I am quite impressed, but I actually made it through with almost 18 minutes to spare. So I want to say thank you. I also want to say wash your hands. Let's see what we have for questions. Let's see what we have for questions here. Question from Carrie. Do you have any multifamily data? We really don't have much multifamily data. I talked a little bit about rentals, but it's just not our bread and butter. We're so focused on single family condos and townhomes. That's really our bread and butter. So not much, but shoot me an email, and I do have some other reports and resources from other folks, not from us. All right, question from someone else. Middle market. So those are positive percentages compared to 2019. Yes, that's correct. That is what the data is showing. An increase from March of this year compared to March of last year. Again, some price ranges were up a fairly strong amount, others weren't. Another thing to note, you guys, maybe let me go back a few here. Sorry, forgive my my speed here. Let me go back a few more. Let's keep going. Okay, so look at this, guys. look at when these listings came on. And you know, I don't know why I'm showing this to you guys. You all know this, or at least most of you do. So we see new listings come on at the beginning of the month, and then they kind of trail off a little bit. Here comes February, we see this surge. Of course, it also helped that, you know, after the Super Bowl, that's kind of when some folks think spring market kicks off, depending on weather. So again, early Feb, we saw a lot of listing activity. All years sort of flatten out, just like they did here before the next rung up. Flatten out, next rung up, kind of flatten out, and some years have taken that next rung up, obviously not this year. So this is interesting. The reason I bring this up is because, look, when you saw this, you know, a lot of these new listings came online at the beginning of March. And so I say that because in this market that's so thin, especially in the affordable ranges, as you guys know, you had buyers who jump on that stuff. As soon as they get that email from the portal, as soon as you call or text them or use social media, however you guys are reaching your customers, you know, you saw people really kind of jump in, and some of them were still in multiples, even if they wrote offers 4 hours after it came online. So, you know, pending sales move a little bit more slowly, but again, I think you do see increases during certain times of the month. Okay, what else we got? Specific to only Dakota County or downtown. So with a lot of this showing stuff, we just don't have, at least not yet, we don't have the ability to kind of split this out yet by area. I'm hoping by later this month or next month, I'm at least able to do, market-wide and maybe Minneapolis and St. Paul and maybe a Bloomington or a Maple Grove or a Plymouth or a couple of the major suburbs, maybe a Lakeville or a Maple Grove, depending. But it's going to be pretty hard to do all of our areas because I think there's over 300 local markets that we track in our local market updates. But I will say, check our local market updates for March, which will be posted tomorrow to our website. Again, it's March data, so it'll be a little bit misleading because the first half was very different than the second. So I really think April will give much more clarity, obviously, because April will be a month where everyone was quarantined. We saw a lot of the fallout already versus what we saw kind of happening here, right? Sort of mid-month there, when we saw a lot of those declines happen there. So I would say check those local market updates. You'll see a lot of different counties, cities. You'll see school districts in InfoSparks. I also should plug InfoSparks within North Star. You guys can see a lot of the monthly data. Again, monthly data versus some of the daily and weekly stuff that we've been doing. But this has been sort of special analysis because of what's going on. All right, what else we got?
David, if you look at the chat in Zoom.
Yeah, let's check it out.
Let's see. Steve's asking about median sales and average sale price % increase over last year for March.
Yeah, so overall, well, maybe I'll, why not? Maybe I'll just, maybe I'll get that for you guys. Got that handy. Let me bring this over. So, I already kind of showed this. This is our March report. Again, I would ask you guys to be a little patient and quiet with this until tomorrow, so that our press release can kind of pick up the media coverage that we want and put our message forward and uplift the value of the realtors. So yeah, we did see again plus 8% on sales price for March. Plus about 5.5% on price per square foot. So even once we account for the fact that bigger homes are selling, and just think new construction, which may be 2,500, 3,000, 3,500 square, versus a lot of the existing product in, I don't know, Minneapolis, Bloomington, Richfield, St. Louis Park, Roseville, you see a lot of 1,800, 1,900 square feet. So that's why I kind of like price per square foot. But yeah, for March, we definitely still saw price gains. I know I've said it about a dozen times, but the first half of the month was very different than the second. All right, let's see what else we got.
It looks like Derek is asking, for some of the showings, does being considered essential skew the numbers versus other states where real estate is not essential?
That is a really, really good question. I don't have a good answer for that, honestly. I wonder if Eric, our government affairs director, would have better insight into that. I mean, the fact that I said it was a good question kind of implies that maybe that is a thing, and maybe people aren't thinking about that as much. So not every state has declared, agents and inspectors and appraisers and lenders and photographers is a big one lately. That got through recently. We heard from the state association. So I think that's true. I think we're showing more than other states would because of this. Again, assuming other states are using that virtual showing option, maybe we're not missing as much as we think. All right. I think Iowa's a more open state. That was why I think, I think that's right, Steve. I think that's right. Let's see. Yeah, duplexes as well. I think I missed the duplex question. We just don't have that much, and we're working on it. I hope in a year or two we're able to cover some of that, but we're just not there yet. Let's see. What else?
If anyone else has anything they want to ask, you can go ahead and unmute too. That might be easier than typing it out. Otherwise, it looks like you did a great job, David.
Well, that's awesome. I'm thrilled. I just hope you guys got something out of it, and I really hope you're able to leverage some of this with your buyers and sellers. We know you guys are being asked questions. We know the questions are difficult to answer. They're even sometimes difficult for us to answer. But this at least gives you guys a lot of facts and data and ammunition when it comes to managing expectations and explaining why, especially by price point, especially that activity by price point, explaining why someone who's in the 750 plus range or million plus, a 45% decline in showings versus just a 15 to 18% decline in showings if you're, 250, 350, or 3 to 5 or so. All right, a couple others.
David, is it possible to get a copy of this, even if it was like next week or something when everything is released?
Oh, I suppose we can do that for you guys. Yeah, so this is being recorded. So if you want to hear my ramblings, I would encourage you guys to, of course, look at the recording. But yeah, happy to send out slides. No problem there.
That would be great. This has been a great presentation.
Thanks so much. Really appreciate that feedback.
Alex, to answer your question, if we're planning on having updates like this in the future, yes, this for the time being is going to be a standing weekly webinar, Thursdays at 2. So absolutely.
Be sure to tune in for our special coverage. Who's MI? They seem funny.
I don't know. I agree with Ted. You're the best in the biz, David.
Oh, cut it out. You guys are making me blush. Come on.
Well, thanks again to everyone for joining us. This has been awesome. If you have feedback too that you would love to send our way, you can email it to me at rosieh@mplsrealtor.com. So,
any last questions? All right, should we call it, what are we, 8 minutes early? 5 minutes?
Yeah, sounds
Not
good.
Bad.
It was really
Not
good.
bad.
Well, thanks again, David, and I hope everyone has a wonderful rest of the week, and we'll see you next time.
Thanks, everyone. Stay well.
Thank you.